Hi, this is Ben Tafoya, and I'm back with another episode of 5 O'Clock Macro. It's Monday evening, May 18th, 2020. We've been taking a little break, but back now and want to share some thoughts on some issues that have been significantly in the news these last several days, primarily as it relates to debt and the next go round of significant actions to help the economy. A week ago, when I was talking to you, I was mentioning the issues related to the actions of the Federal Reserve and some of the strengths of that approach, but some of the problematic aspects of that. And there are some things that I wanted to share with you regarding corporate debt, which is a significant challenge that we face this time. And debt is always a problem when you have these kinds of severe economic contractions. If you have debt, it's typically a fixed payment that you have to make. And if your income goes down, it makes it harder and harder to make those payments, which is why in the last crisis over a decade ago and in the 1930s during the Great Depression, there were so many problems with respect to foreclosures because people could not make payments on their home mortgages or their farms, etc. And so with this graphic, what I'm showing is the rate of change of various aspects of debt over this period since the previous crisis began in 2007. And one notable aspect of it is the sort of purple line below the horizon there is a negative rate of change of household debt. So households actually started to increase savings by paying down debt during this period of time. So that's a particular strength during this period. The blue line is public debt. So that's debt from the federal government, from state and local governments. You can see that rate of change peaked at the end of the last recession, and it slowly went down, but rest assured it's going to steeply increase those blue lines this year as the federal government is taking its actions to try to help boost the economy. The green line is corporate debt. This is for non-financial corporate businesses. And you can see that there's been a steady rate of increase between 2.5% and almost 5% each year of corporate debt. Again, this is non-financial sector, so this doesn't include banks. This is just corporate debt that people have accumulated as a result of various kinds of business actions. So the increase in corporate debt is also sometimes related to the way that investment funds structure corporate buyouts. And we've seen various kinds of problems related to that as these deals have gotten bigger and with more complicated structures and the desire of the investment firms to take money out of the deals as they're putting it together. So, we've seen deleveraging, if you will, which is this process of paying down debt in households. And we've also seen it in banks. So banks have significantly deleveraged in the United States. In part, this is because of regulatory changes internationally as well as nationally that requires banks to hold more capital assets, if you will. And so banks have decreased the amount of debt they hold. But in the recent news we've seen this week there have been significant bankruptcies of private corporations announced. Folks like Neiman Marcus, J. Crew, Gold's Gym, and J.C. Penney, who's been a corporate institution in the United States for a long time. These firms have all filed for bankruptcy protection, and they're in the U.S., law allows for one phase of bankruptcy where you negotiate out your debts with a creditor committee so that you can resume being an ongoing concern. Now, it may result in these companies coming back in a different form over time, or it may mean that they're going to be sold off or shut down or what have you, depending on what's worked out between the debtors and the courts who are actively involved in this process. Now, why is this a problem? This is a problem because of the high debt levels that these particular kinds of companies carried. And in a period of time when they're not generating very much economic activity at all, then they're having difficulty making the debt payments. And so they file for bankruptcy in order to renegotiate these debts. Sometimes it works out that people are willing to accept equity or they're willing to accept other assets. In the case of J.C. Penney, there's talk of a complicated restructuring where they spin off into a separate entity their real estate holdings, which may still have some value. But those of you who follow this stuff fairly closely might be saying, "Well, Ben, I heard about all these different kinds of federal programs, and banks have money to lend to people. So, why are there these kinds of bankruptcies?" And the issue that arises is that much of the pure financial activity has taken place through actions of the Federal Reserve. And as I've mentioned multiple times, the Federal Reserve has taken extraordinary action this time, gone much further than they have in the past. And so with this graphic, you'll see that the Federal Reserve cut temporarily the basic reserve requirements, where companies or banks, commercial banks in the United States, were asked to hold 10% of their deposits on reserve with the Federal Reserve. Because of the actions of the last crisis and changes in international banking regulation, banks had significantly increased the amount of money that they held in excess reserves. So that's what that yellow arrow points to. And you can see in mid-March, banks in the U.S. held $1.5 trillion, that's with a T, in excess reserves. And through the extraordinary action of the Federal Reserve, not even fully 2 months later, the amount of excess reserves held at the banks has doubled to almost $3.2 trillion. This is far higher than the peak back during the last crisis when the Federal Reserve intervened. These numbers will be released again tomorrow, so sorry for jumping the gun a little bit, but there'll be a report as of May 20th, and I would expect that the excess reserves number would be significantly higher than the 3.2 trillion. And what does this mean? This means that this is money the banks have accumulated. So that difference, that 1.6 trillion difference, is money that the banks have accumulated by selling off assets, typically government securities, in exchange for which they receive cash. Now, the Federal Reserve has a couple of different mechanisms by which these transactions occur, but this money has come to banks in the hope that banks would use it to help sustain the economy. At base, that there would be liquidity available to the banks should they need it or their customers need it to sustain operations. Well, again, the question is, why doesn't this money get into the real economy during a period of time when so many businesses are hurting? Why is this money just sitting on the balance sheet of banks as opposed to flowing out in terms of loans? And that there are various loan programs that have been approved by the federal government to help sustain businesses during this period of time. Well, one issue that I've spoken about before is that the Federal Reserve doesn't actually give money directly to households, doesn't give money directly to firms. It gives money to banks, and banks then have to use it. We're moving into a new area where some of those restrictions on how Federal Reserve transactions occur may be lifted, so that you would see some money flowing directly to people, which is an idea that I heartily endorse, because there's this problem that we mention in monetary and fiscal policy, which we call lag. And the fundamental first problem is the recognition lag period. And that wasn't a real problem this time because everybody could see what was coming. But then there's a political lag and then an administrative lag. So the political lag is, hey, people getting together to agree to move forward to do things. The beauty of the Federal Reserve is it doesn't really suffer much from that problem. It's a small group of people, independent of the voting public and their elected officials, that make determinations as to what they're going to do. And they're very aggressively acting in this particular crisis. So the problem becomes with the fiscal policy side, which is significantly necessary right now. So one of the big things that everybody knows about is the $1,200 checks, which have been going out to folks, but they've been getting into people's hands very slowly. So just this week, there was a series of articles about how checks are just now going out to certain folks in the public, like college students. So it took the Treasury a while to get their act together on that stuff. They've indicated that these checks will be spread out over several months before they get in people's hands, and that's money, therefore, that won't get spent immediately. There's another article from today's Washington Post about a relief fund for businesses that has lent out less than 10% of the funds that were authorized from a $500 billion program. And at the same time, the Federal Reserve Chair, Powell, is basically begging Congress to do further actions to try to help the economy. So people shouldn't be misled by these claims that, well, we've already authorized $3 trillion in spending, and we have to sort of wait and see where that goes before we can take further actions. The fact of the matter is that all of that money is not going to be spent. It's never going to be spent, can't possibly be spent. And so the net impact of the actions up to date may have a maximum level, but they're not going to get there, and there needs to be additional action to help resolve some of these situations. Now, I have a great deal of sympathy for the investment funds who own these retail chains, which are having problems. I do have a great deal of sympathy for the folks who work for these places who are going to be unemployed. And that's why in many European countries, they've shown us the way forward here, which was guaranteeing everyone's employment for a period of time and compensating firms for their payroll costs in order not to have these kinds of problems. For instance, the CARES Act that was passed some weeks back authorized an expansion of the traditional unemployment compensation system to allow in independent contractors and gig economy workers who weren't regular employees who weren't paying into the system. But those components are based on state actions, and many states haven't yet gotten to the point where they can make these payments. And this is an example of what we're talking about with respect to administrative lag. It takes a while for these things to come into place, particularly the more complex the mechanisms are, the longer it's going to take for the money to flow and to get into people's hands. In the meantime, the economy continues to suffer. So there's another round of aid that's been proposed. It passed the U.S. House of Representatives on last Friday, and it helps boost federal spending in a number of ways, and it sends significant amounts of money to state and local governments in order to help them for what will otherwise be an economic Armageddon that is due to start on July 1st when the new fiscal year kicks off. The CARES Act also authorizes additional direct payments for individuals and families, and it allocates some money for the direct fight against COVID-19, as well as helping to protect housing security for certain kinds of renters and owners. And these are the kinds of ideas that are necessary now and will help the economy as we go forward. So I'll be back again soon, and we'll talk some more about macroeconomics and the COVID-19 crisis and the U.S. and world economy. Thanks for listening.